Hello, welcome everybody, and let's start now and not wait any longer. My name is Josef Huber, and I'm going to give a talk on this topic, on monetary reform, on substituting sovereign money for today's bank money. And in the beginning, I'm a professor of economic sociology and the co-founder of that organization by the name of Monetative, which is German and a word or a term in analogy to legislative power, executive power, and judicial power, and it's the monetary power. So the translation of monetative would be the monetary power. I will come back to that when explaining what sovereign money and the monetary power, what the meaning of this is. But in the beginning, I wanted to ask you how we should proceed, because so there was some, how should I say, some organizational mishap occurred, and it happens that at 7 o'clock David is presenting his book on 5,000 years of debt at the Dussmann bookshop. And who among you has planned to leave, say, about 6:30 or so, for going to see David Graeber? 1, 2, 3. So it's hot today. It's still in the evening, so I would suggest so we should stop at 6:30. Is that okay? So I have prepared. I try to be brief. I have prepared a contribution in 3 parts, and I thought we can still do that. Let's say we have 1.5 hours, and it comes in 3 parts. And the first part is on explaining how the present monetary system works, and the second part is on why it doesn't work, what the problems are, why it always derails again and again, and the third part is on monetary reform. And well, let me see. I will try to speak myself about 15 to 20 minutes and give you then another 10 minutes or so to come in. So is that okay, by and large?
This is yes.
Okay, fine. So this is yes. I didn't know. Good. So then let's start. I will sit down because I need to see the slides. So now, the monetary system as it stands today, how does it work? Where does the money come from in this system? And for a first description, you can say the present system is a 2-tier banking system. There are 3 groups of actors, and there is a split-up circulation of money on the basis of fractional reserves, which allows for multiple credit creation. All clear, isn't it?
No.
Yeah. No, that's actually a matter for hair standing on end. So you see, it's not very well. The sun is shining too brightly. So somehow you can see on this picture what are the 3 groups of actors. Let's start with that. The 3 groups of actors are exemplified here in buildings. In the forefront, the Twin Towers you see here. This is the new building of the European Central Bank in Frankfurt. And in the background, left above, that's the banking district, the towers there. That's the big banks in Frankfurt. Surrounded by us, the non-banks, as we are called technically. And continue. And so, I wouldn't say non-banks, let's say the customers. We are the customers. The customers mainly are private households and public households, state, municipalities and so on. And third, the firms, companies, big corporations and so on. And so you see the central bank, banks and customers. And normally, if people have any idea at all of how that system works, people normally think that the money comes from the left side, from the central bank. That's where the money is issued originally, and the central bank credits that money to the banks, and the banks pass on that money to the customers. That's what people think, but this is not the way it really works. It's slightly different in two ways. The first thing is that the process starts with the banks and not with the central bank. That's important to understand. The process starts with the banks crediting money to their customers. The money is issued, bank money, that what you have on your current account, the sight deposits, that's issued by way of making out a credit. So that money is created by crediting it. It's not created by spending it into circulation, but by crediting it into circulation. That's important to understand, and that this process starts with the banks. And the second point is, and that's much more complicated to understand, that in order to carry out that process, banks need some fraction of central bank money to carry out that clearing and payment processes involved, which I'm trying to explain. And when banks possibly run short of central bank money, then they go back to the central bank and ask for being refinanced. So, but in the beginning it's the banks, and then when they come to a certain point where they do not have enough central bank reserves, then they ask the central bank to refinance, but not to 100%, not 100%, but just a fraction of it. In this context, we need to understand furthermore that there is a split up circulation of money. There are two separate non-cash circuits of money. And the first is the interbank circulation with reserves. Reserves is the technical term for central bank money. That's, by the way, sovereign money, which means it is the central bank in Europe is, all central banks in Europe are state-run, state-owned at 100%, or at least at 55, 60, 70%. So central bank money in Europe is state money or state-controlled money, and that's sovereign money. And the second circulation is where we are part of. It's the customer circulation with bank money on our current account. So there is also cash, still cash, small amounts of money we still pay in cash, but cash is not important in this. It's basically no longer important. Why? Because cash is just a residual quantity of money which is exchanged out of your account or my account, and then changed onto that account back again at some occasion. So cash is not the original form of money. The form in which money comes into existence is non-cash. It's either bank money, which is credited onto customer account, or it's central bank money, which is credited on bank account. And these two circuits, the circulation in these two circuits, never mingles. No, there is no connection at all. I mean, no, that's wrong. There is some connection, but there is no money flow from here to there. It's absolutely impossible that money from your account will go to a central bank account. That doesn't exist. And in the same sense, money from the bank account with the central bank will never end up in my account or in yours. That's technically impossible. These are really two separate circulations, and this too is important to understand in order to understand what fractional reserve banking means. Now, a little detail, a little technical detail. How is that bank money or central bank money created? In the case of bank money, it's simply it's created by a book entry, and it's very simple. In the bank balance sheet, the entry is, say it's about a credit of 10,000 units of whatever currency, and this is simply written on the asset side as a claim on the customer. From that credit creation, a claim on having paid back that money and on having paid interest on that principal. And on the liability side, that's the liability of the bank to pay out, to actually pay out that means of payment to the customer. In our account, that is in debit and credit, so we have gone in debt to the bank for this credit of 10,000 units. And this is an interest-bearing debt to the bank. And on the credit side, we now have that we can dispose of that credit. It's available to us as a liquid bank money. The credit is a liquid bank money as a means of payment which we have obtained from the bank. Bank money is not legal tender. It's not legal tender in the sense it's not official currency. It's not sovereign currency. It doesn't come from the central bank. It's not cash. Cash comes from the treasury, and banknotes come from the central bank, and reserves come from the central bank. But this is not legal tender in that sense, but in general we use it as if it were. And so, for the most part, money today is bank money. Now, the thing starts to get a bit more complicated. How do cashless transactions, how does that work? But one needs to understand the system of clearing and settlement. And here you see again, why the hell, why is that that can't be changed, isn't it? Somehow.
No, we can see.
Who has the remote for it?
It's okay.
There's like one option to it.
It's okay. Der Kontrast.
Yeah. No, well, now you can see. Okay.
From here is here.
Yeah. Okay. Yeah, let's go on. Thank you. It's okay.
No, we can. That's the best we can do.
Yeah, thank you. So, now what happens if in this chart, the customer of our, there are two banks, our bank and your bank, and what happens when customer A has to make a transfer to customer B just to pay for something. So that's the easiest case. Here simply our bank subtracts some money from my account and adds it to the account of the customer where the money has to go to. And there is no money involved, no money in the sense of sovereign money or central bank money, no cash, nothing. It's simply a rearrangement of the books on the liability side of the bank. The thing is more complicated. Customer A of our bank has to transfer money to, say, customer B of your bank. And how does that work? In this case, our bank has to make, we tell that our bank, and we write out a payment order, and our bank then transfers central bank reserves to your bank. And so you could think that, well, if it works that way, then the bank, for any payment it has to make, it has to carry out, it needs to have 100% reserve of central bank money. But this is not the case. And that's the trick. That's really the trick with fractional reserve banking, to understand why our bank doesn't need 100% in reserves what it has to pay out, but just some tiny fraction of it. How does that come? And how that comes is explained here. Because all those transfers are cleared and settled on a daily basis. And let's assume that in the course of one day, customers from our bank transfer to customers of your bank, customer A 20,000, customer B 30,000, C and so on, customer D 15,000 at different hours in the course of the day. And the other way around, customers of your bank make payments to customers of our bank. First customer O 50,000 units and customer P 30,000 and so on. So at the end of the day, the balances are made, and in the example here, at the end of the day, our bank has to pay to your bank 90,000 units, and your bank has to pay to our bank 85,000 units. So that's the clearing. And now comes the settlement that has to be carried out in bank reserves, and it results that just 5,000 units have actually to be paid out from our bank to your bank in central bank reserves. And the rest is just cleared on books. There's no money flow involved. And the meaning of this is that in the customer circulation, in fact, a total amount of 175,000 units have to be mobilized. And from our bank to your bank, 90,000. But our bank just needs 5,000 central bank reserves to settle all of these deals. That's fractional reserve banking. You need just 5,000 in order to carry out payments for 90,000. That's fractional reserve banking. You just need a fraction of the entire amount of bank money in central bank money. So, and even for your bank, that's really clever. It's nice to be a bank sometimes. So your bank had to pay 85,000 units of bank money, but it didn't need central bank money at all. On the contrary, it receives 5,000 from our bank. Sounds nice, isn't it? That's the trick with fractional reserve banking. And that's what most people do not know. And that's important to know in order to understand how banks create and dominate the entire monetary system, and why the central bank no longer has a very important role to play. Empirically speaking, the fraction of central bank money the banks still need is they need cash 2%. So from the amounts of bank money they create, they just need 2% in cash. So for the tiller machine, when you go cashing out money for your pocket, so because you take it from the machine, I will bring it back to the bank. And the bank needs just 2% cash for the entire transactions. And the banks need 6% the amount of bank money, not more. And if you put it as a multiplier, there is the so-called money multiplier model, or the credit multiplier model. Bank money is 70 times what banks have in reserves and 46 times what they have in cash. So whether you say it's a fractional reserve system or whether you say it's a money multiplier system, well, either way is okay, because in one way you consider central bank as a fraction of bank money. If you consider it the other way around, you say bank money is a multiple of central bank money. So it's a system of multiple money or credit creation. So it has come that nowadays, depending on the country, 80 to 95% of the money exists in the form of bank money, and only 3 to 5 to at maximum 20% exist in the form of sovereign money in the form of coin banknotes and reserves. This chart shows the development since 100 years, and it started around 1870. That's not on the chart here, and it increased until the big crisis of 1929, 1930. And then you see that the following crises, there was a certain sideward movement, and from the 1970s, 80s on, we have again a very strong increase in the share of bank money in the total amount of the total circulating money. So, now stop here for the first part. This was the part about how the money system works. Now, who wants to have specified or explain something in more detail?
Yes, one question. You asked central bank, and you said that it's a certain country that own the bank, the central bank. So who owns the central bank of Europe?
The Central Bank of Europe, yeah, is owned by the member states. It is the member. There are 17 member states, so the European Central Bank is an intergovernmental institution.
Equally its own or not?
Equal in which sense? No, it's not. It's not equal. I mean, that's a bit complicated. There is a formula about the share of every country participating of the 17 countries, and the formula is the number of the population multiplied with the gross domestic product. So it's a combination of size in terms of population and strength of the economy, or say volume of the economy, and that is the formula. That's the way shares are attributed to the different member countries. But the voting shares are different, and are different in a sense that very small countries have relatively a much bigger voting power than the big countries have. So, for example, Germany is the single biggest country, but has relatively much less voting power than, say, Malta or Luxembourg or Austria, or you see what I mean? Yeah, and that's by the way why that's one cause which explains why in the course of the sovereign debt crisis, things went in that way that the bailout, the article of the Lisbon Treaty, Article 125, saying bailout of countries by other member countries, that's not allowed, and that has been overruled, and that was because of the voting shares, because the smaller countries and the countries in a relatively weaker position at that moment, they wanted to be rescued, and they wanted their banks to be rescued, and that's why they voted for intervening, whereas the other banks had not enough voting power to. Yeah. Further questions or commentary, please.
And how is the money backed up? The money backed up with, who sets the value for the money and how much money is created, and where's the counterpart to it? So you need a measurement system, in a sense, and this doesn't exist. It's just, there are some people, and they say we create this amount of money because we think it's right.
Yeah.
That's it.
Oh, no, yeah. Well, first we'll try what you say, but I think, I have the feeling by what you say, or how you say it, that, well, how you differ. No, let's start first with any money of today, no matter how it is created out of thin air, literally. So that, in my opinion, that was already in traditional societies, but we do not have to go into these details. Today, money is created out of thin air. It's fiat money. Fiat meaning the will of the sovereign. So the sovereign says, I want this to be so. And so I declare this token to be money. And this is legal tender, and this has to be accepted in order to pay for debt and so on. That's what's written on the banknotes. So, but this money is not without a value. So the value comes from two. No, I don't change that. So in two circuits, in the circulation between the central bank and the banks, so the collateral the central banks demand are some sort of securities, which ironically are normally, the most of it is sovereign debt. So it's government bonds. So, and even the Basel III rules have not considered attributing some degree of risk to government bonds. They have still the risk 0. So, and well, other securities like private bills of exchange, traditionally, or stocks, equity, stock equity, or what else. And this is transferred as a collateral for the money that the central bank credits to the banks. But the standards of quality have of late been downgraded very much as to allow countries with many problems right now still being able to borrow from their central banks. So then the next step in the customer and in the public circulation of money, the value of the money, but that's general situation. The value of the money is not in the money itself. Money isn't productive, as we know, but what money has, it has a transactive function. And it is the purchasing power which is valuable for us in the money. And where does the purchasing power come from? You need things that can be purchased. So the value of the money comes from the things we are able to buy for money, the goods and the services we are able to buy. So the counterpart of the money in circulation is gross domestic product, formal and informal, also in this submerged economy, the informal economy. So for whatever money can buy, that's the counterpart, and the value of the money. So, and if not enough goods and services at a certain level of quality are produced and reproduced, then the value of our money decreases, necessarily so. And when too much money is produced compared to the growth of produced goods and services, then we will have an inflation, consumer price inflation, and other types of inflation I will come back to in the second part of this seminar.
Myself, when I refer to the value of money, I usually try to emphasize that money has no physical presence. It just exists in people's kind of agreement, fantasy. And for example, with a stone, you can open a coconut. If you have a bucket, you can carry water. It has like a capacity to have some functional use. And money has only this capacity when two people or more people interact who practice money. So if one approaches someone who doesn't use money, this money has no functional capacity because the person say, I don't accept money, it's like useless for me. So I should try to emphasize that it only works if people agree to use it. Because if people say, I don't want to have anything to do with it, it has no useful function anymore because it just becomes irrelevant, just someone's...
Yeah, sounds logical what you say, but for some reason that's highly controversial. And the reason is that from the beginning of traditional societies on, it was not you and me who were to decide what we choose as the token that should circulate as money, but it has always been the sovereign. It was the sovereign who has stamped his mark on the coin and has said, that's mine. You have to take that that's the token you have to use. And that's sovereign money. That has always been the case from the beginning of traditional society. So in fact, even if today the most part of money is bank money, it is still guaranteed by the state's power to create a legal order and to guarantee that the official currency will be the currency that has to be used, which is declared to be a legal tender, fiat money in the sense of legal tender, that has to be accepted in economic transactions as a means of payment. I think, that's the so-called childhood theory of money, and it has, the first time it has played a big role in history. That was in the controversy between the currency school and the banking school in the British Empire in the 1840s. And at that time, that controversy was settled in favor of the currency school, which said we need to have sovereign money, because if we leave it to the banks, they create havoc, they create too much money, they create crises and collapses, they create banking crises, inflation, exchange bubbles, and so on. Now, there are ever more people coming up, but I think we have to. So that would be the second time that you have been before.
Okay.
Yeah.
My name is Herbert Havel. I'm a fan of your ideas for years. Nevertheless, I have two open issues. One is the idea that there should be one institution to create the money, Monetative. I support this idea. Nevertheless, if I compare the centralization and democratization of money on one point, and I compare this to law, then there's one problem I have, because when we invented to democratize law, we invented Gewaltenteilung, checks and balances. Today there are three systems to create, to check, to speak law. But if we have only one organization to create and decide and value money, maybe there's a problem, because tomorrow there's one point, then the government can come and say, hey, you have to do, or, you know.
Yeah, that's, as far as I understand.
How can we avoid the misuse of this idea?
Yeah, well, that's a rather philosophical question.
No, stop.
No.
Last December, we have a European Central Bank. Yeah. Again, I'm a fan of your idea. Yeah. Promoted since 4 years. Nevertheless, this question. The European Central Bank is restricted to do only things which, my English, stabilize the value of money. Nevertheless, they paid out 1.5 billion.
Yes, you're right. Yeah, I agree completely with what you say, but you see, pragmatically speaking, the choice we have today, in real political terms, so to say, the choice is either the government or the banks are creating and controlling the money. And I mean, we have a third option, so to say, that's say complementary currencies created and issued by local communities. But for the time being, that's a sideshow. And I imagine if this would grow or ever bigger, that would end up either as sovereign money or as some sort of corporate, very big corporate money. Because also cooperative banks of the 19th century are nowadays big banking corporations have become. So the real political question is we have to choose between either the government or the banks. And they can much be criticized when the money is under control of a state-owned central bank. It should not be run by the parliament or by the government cabinet. But nevertheless, it has to follow legal rules. Whereas when you leave it to the banks, so first you create chaos. That's where I will come to the second part of the seminar. And I think you are actually undermining liberal democracy and creating some sort of plutocracy. And we still have gone quite far that road, I think, and we have to correct that. So, but it indeed is a very important constitutional question. And as Irving Fisher already put it in the 1930s, he said the question of who has the right to create money and the question of who has control of the quantity of money and so on, and who has the right to take in the seigniorage, the profit from creating money. These are questions of constitutional importance, and I agree with that.
That's what I mean.
Yeah, fine. So I beg your pardon, you have to advance, otherwise we'll not be in time. So the next part of what does it, when banks create money, what happens? That was already the case from the 18th century on, when first time John Law created money in France for wiping out the debt Torsen had left to the French Republic. And the French Revolution, and later on in the British Empire in the 1820s, 30s, 40s, whenever the banks gained control and too much control of the money, what did they do? Guess what? They printed much too much money, always. So the official banking doctrine says governments should not be allowed to print money because they always create too much money. Governments, the banks say. That has been true quite often. That should not be denied. In fact, when the parliament or the government cabinet has the power to demand money from some source of, from the central bank or from whoever, that has been misused. But when the banks have the power to create money, they regularly misuse it as well, and on a much higher level. So you can see this in these figures, which is the increase of the money supply before the onset of the crisis we are in now. This is the decade before 07 or from the beginning of 1992 or so. And one example is the United States. Here you can see that the real GDP in that time, 10 years before the onset of the crisis, grew by 16%. But the nominal GDP grew by 45%. This includes inflation. But nevertheless, the entire amount of the money supply, the real money supply, which in the United States is the monetary aggregate M2 that has to be referred to, has been 80%. And it was still even more marked in Germany during that period, where you can see that real GDP grew by 23%, and in nominal terms, with inflation included, it grew by 51%. But the money supply, the real money supply, M1, so that grew by 189%. So who needed all that money? Why have banks created that much money? And for what purpose? Part of the money they created has been transformed into inflation. By the way, I no longer believe in official price statistics. We are always told our inflation rate is 1%, 1.9, 2%. I don't believe it. It must be much higher. So, but I can't make the proof of it. So they tell me that's the inflation you feel. It feels like that, but that's not the case. But more important is the difference between GDP at inflated prices and the growth in the total money supply M1. This difference is really very considerable. How does it come? And well, to give you the answer in advance, the answer is that money has been printed for speculative financial purposes, for purposes of speculative financial investment. So, here you see simply the increase of the money supply is proportionate to the growth in GDP. You know? So this is a ratio, the money supply, as a percentage of the increase of GDP. That's the so-called Marshallian K. That's a figure was invented by the British. Oh, you don't see? you see this. So the first chart you couldn't see, that was in the Eurozone, and this is particularly in Germany, where that increase has been particularly high. As you can see, starting around 1980. So the crisis we are in now, all of that started in America in the 1970s, in Europe in the 1980s. And you can clearly see how the money supply increased in that time. That's the United Kingdom, Britain, and that's the United States, that is Japan. You see everywhere the same picture. Here you see the connection, the link between the money supply and inflation. That is a very robust link. No matter how you do it statistically, it results in such a picture. You see the dark picture, that is consumer price inflation, and that very bleak curve above. You see it somehow. So very, very pale, but somehow it can be seen. That's the money supply. So that you can see it's the same rhythm. That's a chart of 100 years. But this is the real subject we have to deal with today. That is the increase in financial assets. That's what I said right now. On the right side, you see the increase of financial assets in the United States. And the thing is that disproportionate growth of money, of bank money, I have to say, that is used for, as I said, financial investment, to have leverage, to use credit in order to leverage up financial investment. And so total stock of financial assets in whatever form, in the form of government bonds or stock equity or private equity or whatever, you can see that it was rather stable until oscillating on a stable level until at around at the end of the 70s, 1970s. And from that time on, it's a real take-off curve, and it grew very extremely up to more than 1,000% of GDP. And that has very, very strong, severe implications. And the same thing you see on the left side, that's a chart for Germany, where you can see the black line, that's GDP, and the very steep line, that is the increase in financial assets and monetary assets. That's the same picture, the expansion of bank money as a leverage for paper investment in financial assets. Here you see who has done it. That's the red sector of this chart. You see that the assets, that's the one side of the balance sheet. The other side is the debt. And who is the one who has gone into debt to create all these assets? So this has been, firstly, the governments. I come back to that. But then the financial institutions themselves, the banks. The banks have created the money, and the banks create most of the financial assets, the financial institutions, and the banks are the ones who go into debt to each other. They credit money to each other, and they go into debt at each other. And so they're spiraling up the whole thing. And so you can see how the banks and the financial businesses have gone into debt in order to leverage up all of their financial investments. Now we have to bail them out because they are over-indebted now. They have gone too far down the road. No way back. So that's the same picture now. That is the total national debt, including all kinds of debts in nations, and that has reached, you see that on the right side, incredible levels of 300, 400, 500% of GDP. That is very, very high levels. No one knows how to come back down again without haircuts, without writing down all that. A regular way to come back from that how did he say, the Mount Fuji of borrowers and debtors. I think there is no regular way to come.
War. Normally it's solving war. War.
War. Yeah, that too is a way of destruction of assets. Yes, you can see that way. Yes, and after that we'll have a currency reform. Yeah, maybe. No, I don't want to be cynical.
No, it's not cynical. It's working.
Okay. So here you see at the liability side of the entire game, you see the growing national debt. This is the case of Britain. This is the case of Japan, where this dysfunctional development has gone farthest. This is America, the United States. Here again you can see how all that started in the 1970s, 1980s. This is Germany again. So whatever country you are considering, it's always the same picture. So more or less, these are the levels of government debt that have been reached, now around 80 to 120 to 200% of GDP. And so the important thing to know is who owns that government debt. And interestingly, if you discuss that subject with politicians or with bankers, they say, these are your savings. It's your savings. How can the government go into that much debt? Where does all the money come from? So, yeah, it's your money. It comes from you. It's your little share. Completely wrong. That blunt disinformation. That money is being created continually by way of bank credit in the context of fractional research banking. It's the banks who create that money out of thin air. And then it went into circulation and has 1 or 2, 3 times for some real economic consumption or other purpose. And where it is ending up? In the financial economy for speculative money investment. So that's the way the money goes. And here you can see who owns the government debt as interest-bearing bond assets. 60% of it is owned by the banks. That's the biggest part of it. Further, about one third is owned by funds, by mutual funds, hedge funds, and so on, and insurance companies. In the United Kingdom also there are some pension funds. So it's at least pension funds, it's pension for the people. But nevertheless, I mean, most part is for other financial institutions. And only 7 to 16%, depending on the country, are owned privately by you and me, if any. So I know from memory in Germany, I think it's just 7%, and in countries, in Italy, it's, I think 14%, in Japan it's 16%, but not more. The rest is created and owned by the banks. So keep that in mind. And now what happened was that you see it here in the right above, so in the right corner. So that was, how should I say, the last boost or the last straw or so. And the last boost of credit creation for the purpose of financing additional public debt. And what is important to see is governments had to go even further into debt for saving the banks, who create the money for the governments who go ever deeper into debt in order to be able to rescue the banks. How would you call that?
Vicious circle.
Yeah, vicious circle, or simply call it idiotic. Yeah. That is really it's paradoxical. And when the banks realized that situation, suddenly they realized, oh, we have to go too far down that road. That road has come to an end. That won't work any longer. And from that moment on, we had the so-called sovereign debt crisis we are in now. It's as a consequence of the banking crisis. From that moment on, the time before, we at Monetative, we thought, there is too much government debt, why aren't we in the midst of a very severe crisis? But nothing happens. The debt grew ever more. But from a certain point on, when the banks had to be rescued and rescued again, then suddenly the banks themselves had the idea, oh my God, how will we come out of that mess again? We won't come out. The government has to come to rescue us. Sorry, just one moment. That was the moment when they revised all of their ratings, and when the bond yields in the eurozone they were converging before, and from that moment on they were wildly diverging. And from that moment on, we have the crisis. Now, an additional very important point here, that exorbitant creation of financial assets out of thin air, that has a very important consequence for the distribution of income. Because any income, be that income of labor, earned income, or be it interest on capital, investment income, or be it taxes in the secondary distribution, all of these incomes have to be paid out of the current GDP. And if interest-bearing monetary and financial assets grow disproportionately to the GDP, and then this directly will lead to disproportionate growth income from financial investment or from interest respectively, and correspondingly this will involve a declining share of earned income. And this is what you see here. That's going back to the midst of the 1970s. That was the point where earned income was in the primary distribution, where earned income was highest, the share of earned income. And from then on, that we have that decline, which you can see. And earned income and investment income together are always 100%. And so you can see when the percentage share of earned income is going down, so in your inner eye you can see the converse picture that investment income is going up. This is an aggregate statistic showing the same thing from 1975 onwards. And this is where you can see where it ends. And so David Graeber really he came to the point, he really got the point when he said, we are the 99% and those are the 1%. This is actually true, as you can see from this statistic. We are now we have reached a point equal to, very similar to what was the situation in the end of the 1920s when the crisis broke in 1929, sorry, the beginning of the 1930s. At that time, the top 1% earners earned almost 25% of all income. And today we are in a very similar situation again, and it's even more pronounced when you consider the top the promille, 1 promille of the earners, 1 promille of the earners earn about around 10% of all income. That's a very high concentration, displaying a growing and very marked inequality in income distribution. So that's the picture, and that is where we have come with creation of bank money in a system of fractional reserve banking. So the financial causes of the crisis, the conclusion of this is that the financial causes of the crisis have a common monetary cause, and this is excessive credit creation within a system of fractional reserve banking. And so I think monetary reform is necessary, is inevitable, in order to solve some of these problems at least. And I think personally I'm convinced that all of these reform measures that have been discussed now the last 3-4 years, it's still about financial reform. It's about, I don't know what, financial markets regulation and bank regulation and capital requirements and solvency requirements and so on. I mean, you can do this to a certain degree. Up to a certain point it might be useful or reasonable, but I think it won't work as long as this is not based on a monetary reform, because as is indicated in this chart, there is a certain systemical hierarchy. Within the financial system, the core subsystem of it is the monetary system. And you can say that the monetary system conditions and controls the financial system, as the financial system conditions and controls the real economy. And in this sense, you can say that money governs finance and finance governs the real economy. It's of course a two-way process. There are of course loops, so feedbacks for sure, but that is basic. Say it's a system structure. So, and this is, I think, so that's why I think that as long as the monetary cause of all of these financial problems isn't changed, all of these financial reform measures will not lead very far. So that much for the second part.
I have one problem with that yet. I don't know how I can explain how I can convince 500 million people with the 500 years of history of successful fractional banking. Because we have this banking system now 500 years. Well, there were some wars, there were some bankruptcies. Nevertheless, over the period of 500 years, it created a lot of Wohlstand.
Wealth, yes.
Wealth.
Yeah.
Now you have come up, or you and me, come up and say, nah. The last 20 years we have a big problem on the monetary side, and now we have to change the whole monetary system to a new one. How can we convince 500-year history and 500 million people in Europe to be wrong?
Well, that system doesn't exist since 200 or 500 years. That system exists since 30 years. And we had before...
The fractional banking was invented. Mid-age?
No, not really fractional banking. System of crediting was developed in late Middle Ages. But that wasn't fractional banking in the sense of today. Fractional banking in today's sense, I would say, that has been developed in the course of the 18th century, I would say, but it was not really dominant. The first time there was a danger of it becoming dominant, that was, as I said, in the years 1820s, 1830s, first in the British Empire, and that was the reason why they had that academic and political controversy over whether there should be a sovereign currency rule or an independent banking rule. And that was the first time, and from that moment on, the situation was somehow under control because they introduced a strict gold standard. So the creation of sovereign money was related to the gold standard. And the government had to make sure that that gold standard was kept, which was more or less the case. they had problems, and it was more or less the case until 1931. Then the Brits took their money off the gold standard. And finally this was again done by the Americans in 71. And I would say, according to my knowledge historically, the first phase of where fractional reserve banking developed, that was in the time from around 1870 up to the 1930. And that was first time recognized and analyzed by the so-called Chicago group, Milton Friedman and Frank Knight and Henry Simons, and also the young Milton Friedman, and above all one of the foremost economists of the time, Irving Fisher, in the 1930s. And as I showed in the chart with the development of the money supply, there was a certain, I wouldn't say equilibrium, but a certain calmness of that, on that front, so to say, until the 1970s. And then there was a second round of, say, overshooting credit creation and money supply. And that is, I think this is a dysfunctional development. And interestingly, in the academic sphere, you will have difficulties in finding academics, economists, who openly speak out in favor of a free banking system. Most economists think that that's a question of constitutional importance, it's part of the legal system, and it needs to be state controlled because the prerogative of creating money is comparable to the tax monopoly of the state, or say the monopoly of the state to fall back to use force in case if necessary, and so on. Most economists concede that, but they pretend we have a currency system, or we have a dual system, but the central bank, they say, is able and in effect controls the money creation of the bank, and that's the error. Yeah. Okay, please.
Please comment on the following idea. Whenever the government come to privatization and then something after nationalization, take the cycle, why not to involve the people in the concern of the government to do that act, a group of people to be equal shareholders in the institute being supported by that act. So now let's go to banks. Sooner or later, banks will ask bailout. This is nationalization. So the government somehow will suggest we do it for the favor of the people, and then to name the group of the people and to take the individuals to be equal shareholders somehow in that institute, the bank, and with some specific agreement that will not let multiplication of positions and will not let changing the agreement, so that when it is privatized again, those people will gain.
Well, I'm not sure whether I really understand what you are saying. Have I got you right that you propose some sort of people's committee should be part of the central bank board? That board that decides on how much money has to be created every fortnight.
I talk about commercial entities,
Yeah.
about equal shareholders that have voting power.
Yeah.
They are just there in any case, but they are small equal shareholders. So then none of the so it's not it's decentralized. It's the answer for him how people can participate in that. It's the control goes back to the banks, but the banks owned by the people.
I'm afraid I do not. I'm afraid I do not understand what you are saying. Perhaps we could go deeper into that later on.
Yes.
Okay. Fine. Please.
I'm a big fan of the simplicity is the key in everything humans do, and when we saw the history now of the whole fractional banking system, we saw humans created a system and they began to manipulate it in favor of greed and power. So, and just a few people did it. And so we identified the problem. So when we identified the problem, it's easy for us to find a solution to this problem. Many humans tend to analyze and overcomplicate things over and over to make such a confusion in their head that no one's any more interested, and they say, "Oh, let them do it again." Instead of making it understandable for a 10-year-old child, and it is understandable, you can explain the money system to a 10-year-old child, and it's not a problem that the 10-year-old child will understand it, how it works. So we've created a whole system of experts, of university professors who are so stuck in their own system that people still think they rely on these people. And they are the ones who don't want to make space for the people to come in to figure it out themselves. And
as far as I understand, you have a very optimistic approach to the entire thing.
It's the time we approach now, or we in. It's everything's changing because what doesn't work will not work. Period. There is no if anymore.
Yes.
So every new system that will be based on greed, and they try it again and again.
Yeah, well, but you see, the system we have, the system which is in place, the fractional research system, are developing since 1 to 250 years. It doesn't work properly. It works somehow for a certain period of time, then it derails. And it derails
by design. This crisis is by design.
Yes, but,
so we're too smart
people
now.
People and governments and banks continue. They keep continuing. They keep that system.
Yeah, they keep their game. But now, what you can see in the charts.
Perhaps we have reached the threshold, and I can assure you, the system we propose is rather easy. It's simple to understand. I hope so.
Yeah.
Okay. We need to advance. Am I allowed to advance to the third part? Okay. So, yeah, the last thing I said was about the need for monetary reform, because the monetary system is the core of the financial system. Who controls the money controls the financial system and the real economy. And so, to put it simply, to put it in a nutshell, you could say we want to, on an up-to-date level, we want to restore the currency school idea that was already put into practice in the 1840s and later on. So we want to have not a banking system, but a currency system. Banks shall remain free enterprises. We do not want to nationalize banks or such things, but we want to have state control of the money. That's the important point, because the right to create money and to control the quantity of money, that's a state prerogative, and it should be given back to the sovereign or a state body that acts as the sovereign. And that's why in English I came to call it sovereign money. That's according to a monetary reform initiative in the United States, and in England already 20 years ago, it was Ken Bonser who called it sovereignty. And the idea was of monetary sovereignty. It's a right, it's written in the American Constitution, by the way. It's, I think, section 6 or so, that Parliament, the American Congress has the right to coin money. 8, thank you, so section 8. Yeah. Fine. And so he created that initiative, sovereignty, monetary sovereignty. There is also an economist, there was an economist in Italy by the name of Giacinto Auditi, who had the same idea that a nation state, an independent state, a sovereign state has to have monetary sovereignty. and the money it creates and issues and spends into circulation, that's sovereign money. There are alternative terms you might come across: plain money, genuine money, positive money, sound money, sensitive money, I don't know what else. So all these terms refer to the same thing. And in former terms of, say, the Fisher proposal from the 1930s, you may have heard of the system of 100% reserve banking, or 100% money by Irving Fisher. That's along very similar lines. So these are not different approaches, but these are converging approaches, or even much the same approach, but there are different words for it. So today I come to call, so I have taken the habit to call it sovereign money, because it refers to monetary sovereignty, which we want to restore as a traditional right of the independent state. And that means that all money will be chattel money, that's the technical term. And there is bank money and chattel money state money or state control. Fiat money, I explained that before.
Excuse me, one question of the independent states. Which state is really independent?
Yeah, legally, yes. I mean, in
Germany is even not a...
No one said any time that there is true independence. We are all interdependent, and some are more dependent than others. But legally, nation states are independent, and even within the European Union, that's still a union of independent nation states.
Is Germany an independent nation?
Legally, yes.
By law?
No, yes. In real political terms, no one has ever said that there is independence. It doesn't exist. There is no absolute freedom. We are all interdependent. But in legal terms, there is independence, and the nation state has the right to autonomous creating its laws and so on. It can, of course, partially...
so states are not companies?
No, not at all.
But it was before ESM.
States have a different...
But now they are companies.
No, not really.
Yeah,
I disagree.
come on.
No, I know that. No, that was the influence of that so-called neoliberal thinking or supply-side economics from the United States, where you had a certain... during a certain time, it was some sort of fashion to consider public entities as if they were commercial entities, but that has now come to an end. That was just, that was a fad.
Well, our parliament has a tax ID number.
Well, that's, sure, why not? That's a different thing. All actors have that. But public institutions have different functions different from commercial companies, whatever their purpose is.
That's exactly in what way? In what way different?
Well, I would like to concentrate and present this monetary reform approach, because the issue you are bringing up right now, that's highly interesting, but that's much more complex than we have time to go into. So, yeah, the difference from, an important difference to the system in place is that after monetary reform, the monetary units that exist on account or in cash are fully valid legal tender in and of themselves. There is no more a split system or a split circulation of money, but just one integrated circulation of money, and all of that money comes from a single source, which ought to be an independent central bank as the fourth state power, the monetary power. This is important. It needs to be independent. So it shall not have instructions, or it shall not have to follow instructions from whoever, not from the side of the parliament. Parliament has to make laws. So the central bank in a sovereign money system, the central bank has, of course, to act according to the law, and the parliament is making the law. Also the law for the central bank, and the law for, even in Britain, is making the law for monetary policy even. So that can be the case. But from that moment on, the central bank needs to be independent. No instructions from the side of the government cabinet, from the side of the treasury, from the side of the parliament. no instructions at all, and of course no direct influence, formal influence from the side of the banking industry or financial institutions. It really needs to be independent, an independent state authority. That's the important thing. That's the source where the sovereign money comes from, and that body decides how much money is needed. I will say.
Is it the ESM?
Hmm?
Is it the mechanism of the ESM?
No, the ESM is a very different thing. The ESM is some sort of, how should I say, it's an emergency construction because the Lisbon Article 123 1.1 says that it is forbidden for central banks to directly contribute to financing public bodies. So that is a law, an enabling law for the banks, because the banks wanted that the business of creating money shall be reserved to them, and that the governments be dependent on the banks and the financial markets. That's in Article 123. And so they created, among other things, ESM and its forerunner in order to circumvent that article, because the ESM shall have the right to directly contribute to financing the government, which is normally forbidden. It's a confusing legislation, bad legislation creating bad solutions to it.
But doesn't the independence of states ending with the ESM contract in this case?
No, I don't think so. I'm not very favorable for the ESM. I see the ESM and that entire sort of policy very critical. I do not agree with that, but I don't agree with saying that it's the end of state sovereignty and it's the end of, I don't know, I agree either.
It's the end of democracy.
No, I don't see why.
We have no choice to...
How can we resist?
That's what is already said right now to, say, the European Union in general, that it has a lack of democratic legitimization. I see that in a much more differentiated way. I don't agree with, should I say, two simple answers saying that there is no democracy in it, or it's
Who control that ESM?
What do we call democracy?
Some people do not elected.
No, that's not that easy, you know, because when you go back, when you try to go back to the roots, well, who is the people? Who represents the people? You have a nation of 50, 100, 200, 300 million people. How you are going to practice direct democracy in such numbers? It's completely out of any imagination.
Information
That
age.
is what we try to deal with this.
Yeah. But you see, during my life, I have been involved in quite a number of initiatives and experiments with direct democracy. And my experience was that in most cases, again and again, it resulted in the rule of some elite, normally self-choosing. Well, that's not a real perspective. I wouldn't. You see, democracy the democracy the way we have it. So it really has its shortcomings, and it can and should be criticized in many ways. But as already Winston Churchill said, I do not know of a better alternative. I know of possibilities of including or implementing elements of direct democracy within representative democracy. I'm in favor of that, but that strategy too has its limits. Okay, I would like to explain that sort of monetary reform. There are now across the world quite a number of reform initiatives sharing that type of analysis I have given, and sharing that reform proposal of a sovereign money created by an independent monetary authority and so on. This is a little selection of these initiatives. There are more, double or triple that. For example, here in Germany, Monetative, we have founded here in Berlin, and there is a sister organization in Switzerland by the name of Vollgeld, which means sovereign money, plain money. It's a translation of the term full reserve or full plain money, 100% money in that sense. In Italy, there is an initiative by the name of Moneta Proprietà, going back to that idea of monetary sovereignty. There are actually 4, 5, 6 initiatives in Italy. In France, it's a group called Osons Aller, which means let's try to put the ideas of Maurice Aller into practice. Maurice Aller was a Nobel laureate, a French Nobel laureate, an economist, and he was behind that ideas of Irving Fisher of 100% full reserve system. And in perspective, that's ending up in what we call a sovereign money system and a monetary, creating an independent monetary authority and putting an end to bank money. Quite successful in Britain is the Positive Money campaign. One sister organization is in New Zealand. Another one is in Ireland by the name of Sensible Money Initiative. And last, not least, in the United States, there is the American Monetary Institute. And all of these groups or groupings and initiatives and organizations or non-governmental associations, all of these share the ideas I have put forward here, and it can be summarized in 4 points. These 4 points are listed here. The first is re-establish monetary sovereignty and sovereign money. And re-establishing means doing away with the bank's power of creating money. So what shall be stopped is the bank control of the banks of the money supply. That's the important thing. In that sense, re-establishing monetary sovereignty and creating sovereign money, restoring the full state prerogative of creating money, including coin banknotes, as well as money on account and money on mobile storage media. Second, develop already existing central banks even further to becoming truly independent monetary state authorities. The 4th power, the monetary power, which is conferring responsibility for the entire stock of sovereign money to that authority. And third, which is necessarily included here, is no more bank money, putting an end to the creation of bank money, which is credited into the books on the basis of fractional reserve. And fourth, and equally important, is make sure full seigniorage, which is to say that newly created money by that independent body shall be spent into circulation through public expenditure. That's important. As much as possible, sovereign money should not be credited into circulation by way of bank credit. That can be done if necessary, why not? But normally and regularly, additions to the stock of money should be issued and brought into circulation by spending it into circulation through government expenditure, and in this way the full seigniorage, which is the profit from creating money, is called seigniorage. And that is the full seigniorage is realized to the benefit of the public purse. So that was the currency of the banking school, and to be brief, such a monetary reform has a number of important advantages. One is that money on account can no longer disappear. You know, bank money is credit, and when the bank fails, then the credit can fail, and so that money can disappear. So if it's not guaranteed by state guarantees and interbank insurance arrangements and so on. Second, since the total money supply is under control, there needs to be no more pro-cyclical overshooting or undershooting of the money supply, thus no more so these excesses on the financial markets and these excesses in business cycles, this overshooting now, that these entire processes would be more stable and more moderate. Business cycle would be, financial investment cycles would continue to exist. Why not? Not with that excesses. So within certain limits, which are defined by the availability of money. The availability of money is determined by the money supply, which is determined by that independent monetary authority. Third, since the money supply is under effective control, there need no longer be much inflation or no inflation at all. So to say, zero monetary inflation would be possible. It might not necessarily be desirable, but technically that would be possible. And to come to an end, the most important nowadays, where we are in the midst of a very severe sovereign debt crisis, that such a monetary reform would immediately help to overcome that debt crisis, because the bank's seigniorage, or what is it in reality, a margin extra profit from credit creation, that would be abolished, and the full regular seigniorage from creating the money, it would be the public purse that would benefit from it, and that's an amount of money representing from 1% up to 6% or even more of the total public households, depending on specifically which country we are talking about, and depending on the economic growth next. And fifth, and right now the most important point is that the transition from bank money to sovereign money includes a one-off advantage, because one time you have to make the transition, which is to say you have to phase out the bank money within 2, 3, 4 years, depending on the maturity of outstanding loans. Within 2, 3, 4 years, you have to phase out. Bank money would be phased out smoothly, very organically, and to the same rate, you can and have to phase in new sovereign money. And that creates a one-off seigniorage, very high seigniorage, which would allow to redeem public debt to the extent of 50, even 100%, in Switzerland even more. I'll show you just some figures. For example, in the European Monetary Union, the annual increase of the money supply in recent years was 200 to 350 billion euros. Very much money. Very, hardly to have a real down-to-earth understanding of what it means. 200 to 350 billion euros. So equally in the United States, broad money, 300 to 70, 150 billion dollars. And this, of course, that was before the crisis. That money supply was certainly overshooting, and I think as a rule of thumb one can say that the money supply should and would in the long run increase at about the same rate as GDP would grow. And it would be the task of that independent monetary authority of the central bank to make sure that the money supply increases at about the same rate as economic potential will evolve. So that's the idea of potential, so-called potential-oriented money supply. It's a long-standing central bank philosophy, but it could not be put into practice because we have that system of fractional reserve backing. So that idea of money supply according to economic potential, or in corresponding to economic potential, has continually been undermined by the dominance of the creation of bank money. And so one day during the 1980s, the central banks gave up their philosophy because they realized that they were unable to put it into practice. But that is in fact the right idea, and under the system of seigniorage reform, sovereign money, that could be put into practice. The numbers, the figures would be less, but even if they would be half of recent amounts of money being created annually, that would still be enough as to finance in that way, as you can see here in the right column, from depending on the country, from 1 to 4 to 7% of total public expenditure. That's much money. To that degree, you could you would have to levy less taxes. You could spend more money for education or for the environment. I don't know what. Would be an important contribution, annually a regular contribution to public budgets. More important now, the last point, is that one-off transition seigniorage, which accrues from phasing in new sovereign money while phasing out old bank money. As a first proxy, look at the existing demand deposits. So that's not the entire picture, but the first proxy. That's bank money, the demand deposits on existing current accounts with banks. And that stock of money, that stock of demand deposits in the European Monetary Union is it's next to 4 billion euros. And total government debt within the Eurozone is next to 8 billion euros. So you can see, if you replace bank money with sovereign money, you can pay back half of the entire public debt. There would be no more debt crisis, because the level of public debt would be reduced to levels acceptable. No, the crisis would be over. Just one moment, please. In the United States, it's very similar. Broad money is next to 9 billion, and the total government debt is 70,000, etc. Again, about half of total public debt. Here you can see a more realistic picture, and it's not just customer demand deposits that have to be taken into consideration, but also interbank demand deposits. That is not disclosed in bank statistics. If you want to know it, you can know, but normally it's not disclosed in the same way as monetary aggregates are disclosed. But as you can see here in A2, interbank demand deposits, that's quite much money, and these amounts of money would also have to be replaced. And then there are also the reserves of banks with the central bank that have been credited to the banks. If you take all these positions together, look for example at, say, the EU17. So the line in the middle, and in the year 2010, and then you can see that the entire stock of money that has to be replaced, or would have to be replaced in the course of such a monetary reform, is 7,796 billion of euros. And no, excuse me, please, that's the total public debt. It's time we come to an end. Now, the total stock that has to be replaced is here, 4,588 billion of euros, and the total debt is 7,700, and so on. And so that the amount that has to be replaced represents 59% of the total public debt. and that could be redeemed. So I mean, that would even have an advantage for the banks, because the debt would really, there were no haircut. The money would really be paid back. They would have their money back. Would not have say you have to write off the money. You have to accept the haircut, take it or leave, take it or go. No. So I mean that's an additional advantage. And so that would be a way of dealing with the public debt crisis that would not demand particular austerity programs, that would not demand to accept more unemployment and more people getting ever poorer just in order to rescue the banks, or demanding from the banks to accept writing down public debt and risking of having to fail for bankruptcy, or for again being bailed out and so on. It would really be a smooth way. And I personally, I do not understand why politicians don't understand and do not vote for that option. So that's not what I wanted to say. So, now again, who again, please? Yeah. Who was it? Long ago, already half an hour ago.
I would like to know, there are also groups promoting these ideas of free market money, which is a quite different approach. I would like to know, what do you think about these ideas? Are you against it, or do you think it's possible to combine like this sovereign money reform idea with free market money, or don't think that would be a good idea?
I don't think so, because that's really a struggle between government and banks, the struggle between legal order and the struggle between banking order, and that will all come up again and again. The situation shall be made clear. We should have a currency rule, and this is sovereign money. Else we would have banking rule, and I do not understand. That was the book of reference in this case nowadays is the book written by Friedrich von Hayek. So denationalizing money, and normally Friedrich von Hayek has written quite many interesting things, and things I agree with. But in that point, I think he's completely wrong. That's the reason is, I think, that he hates the state. So he hates everything that is to do with government.
But why?
And well, why? Because there are many reasons. I myself, I don't like bureaucracy. So I agree with Hayek that bureaucracy, no one likes bureaucracy. But in a framework of the rule of law, one has to accept a certain degree of bureaucracy. The thing simply is, free banking is somehow, it's idealized, I would say. It's idealized, and in the terms of Lenin, I would say, so free bankers, if they do not have commercial interest themselves, are those useful idiots for financial capital, because free banking system very quickly will end up in a plutocratic rule. It will end up in the rule of, nowadays, in the global rule of a handful of very large mega banks, having control of the total money supply and being in control of the total financial and real economy of the entire world.
The problem is that
that's the perspective with free banking.
The problem are the human, the technocrats, in the name of the government, that could work otherwise after the career in other places. So the problem is that we put a lot of trust in actually humans, not in institutions, not in laws, in humans that are in position, that are so powerful in the state, as you suggest, and they could continue the career afterward in the business. And that should happen normally.
Yeah, I see that problem. There is a certain trade-off between an anarchic idea of democracy and the real concrete systems in place we live in. those real institutionalized systems we live in, those formal entities, all of those formal actors, personal actors don't count anymore. And I see that. I'm asking myself, where in this world has freedom or liberty really, where is the place for liberty and true freedom, so to say? I do not have a very clear answer, because we live in this world of very big corporations and corporate actors. But particularly because we live under such conditions, we have to make sure that the money is managed in a way which is oriented towards the overall economic development in the interest of state and society, and that the money supply is not managed or mismanaged in the interest of individual banks. So that's a big difference. And when you leave the money to free banking, the money supply will be managed according to individual commercial profit interests of those banks. But if you leave the money supply to that independent monetary authority, the money supply will be managed according to the prospect of the entire real economic development and serving that entire development. That's a big difference, I think. I should have someone who here as
just a short question, maybe.
Yeah, there are so many people.
Does that
Who was first? I've lost control.
It's just short. Does that idea of monetative means to take back the power of banks to the sovereignty of states, and this sovereignty of states back to the sovereignty of the property, the citizens? Finally.
In a certain sense, yes. Yes.
How will you
In a sense of constitutional theory, yes.
On the one hand, on the one side, you are criticizing money supply as being grown too much money in the system. On the other hand, you propose to exchange the whole bank money by plain money. Isn't that a contradiction? Isn't then too much plain money in the system afterwards?
No, I mean, that kind of monetary reform exactly has the task, among other tasks, to make sure that the money supply grows or develops in accordance with real economic development. That's part of the reason why such a monetary reform shall be made. And now what you pose is the question, what is the optimum, how can we be sure that the amount of money that exists right now is the appropriate money supply? It isn't. But,
so that involves write-downs to the banks. That involves a write-down for the banks. My problem with your thesis, and thank you very much, it was very clear, and I think there's a great deal about it, but I think you underestimate the smoothness of the transition. You are, by replacing bank fiat money by sovereign fiat money, essentially destroying the business model of most banks. And you're implicitly writing down that extra 90% speculative money. I think maybe we should be honest about that. And that's my first comment. I have a second comment, whether it would be possible to institute a kind of parallel fiat sovereign money in somewhere like Greece, where they could start to begin to pay their public servants, who all suffered a huge decrease in income, in sovereign, non-debt-based money, and slowly that kind of good money would start to drive out the bad money of the euro in the peripheral countries.
Yeah. Well, you see, I would not say that such a reform would destroy the business model banks are working on. It would take away a considerable part of banks' business, particularly in investment banking, and the creation of credit for purposes of investment banking. Yes. That far you are right. But
They become retail banks, essentially.
yes, but for the rest, what those investment bankers have called boring banking would continue to exist, quite unimpaired. The difference would be that the commercial banks could no longer, among themselves, the money they want to have, but they have to make sure that they finance the loans that may go to 100%. That's the difference. So banks would be intermediaries of money and no longer creators of money. That's the difference. And certainly, I guess once they would have a closer look at that approach, they would immediately start to hate it, I'm sure. But I mean, that's not a natural law that banks always should have extra profits at the expense of society and at the expense of earned income. I wouldn't agree with that. So I'm strongly in favor of changing the business model of investment banking without completely doing away with it, because there is a real need for a financial economy as well. We have to make savings, companies have to have equity and property, and so on. So, to a certain extent, there is a real need for financial transactions and for building up capital and so on. The question is, where are the limits of it? And when you see that statistics, when you can see that for decades, the one to have such a flyer, yeah. I'm sorry, this is just in German, but we can pass it on. Please be so kind. And the thing with Greece, I don't know, that time was having a split currency for domestic purposes and foreign purposes, foreign trade and exchange purposes. That's a more or less proven model applied quite often in history, but normally that's an emergency measure. And,
without having I don't see much of it.
Yeah. So what I want is you can do that as an emergency measure, but it's not really a true future perspective for how to develop a monetary system.
It's close to that. There's one thing that I do not 100% understand. So you told us that in the 1980s, more or less, the amount of money in the market was equivalent to the gross national product, more or less. And then it doubled, tripled, whatever. So right now, in the time we are living in, it's between 6 or 8 or any number. Yeah? So it's much, much higher. And as far as I understand it, so this money partly goes into assets like buildings or on the stock market, and there's an asset price inflation. That's one term that I get. So if you start in going into, if you go into that transition, transforming that money, so what happens then to the prices, for example, of the stockholders or the people who bought a building? If you reduce the money, there must be something like an asset price deflation. Or is it a wrong thinking that I have?
Not necessarily. What would happen in the first place would be that a reduction in bonds, in government bonds. So those untenable high levels of government bonds, these have to come down. So, and by historical comparison, I would say government debt at about 10 to 30% of GDP, that's not so bad. That can be kept, but possibly not much higher. But I mean that, of course, that will remain controversial. But that very much reduced government debt, that would, of course, where would that if that money is redeemed in a regular way, where would that money go to? And I guess it would actually go into equity and would not necessarily create asset price inflation, but would stimulate public or semi-public offerings for companies becoming a registered company, taking up equity at the exchange. I see a great future for private equity, for cooperatives and other type of enterprises and undertakings who are in need of taking up money by way of private equity. There are, depending on various countries in America, there are different legal traditions than within Europe, and in Germany very different legal traditions than in England and so on. But in this or that way, much could go into private equity. Some of it certainly would go into real estate, which could be a problem. I wouldn't deny from the outset. But by and large, since that includes a certain time period of transition, I mean, there is always an ongoing reshuffling of portfolio composition. And investors always recompose their portfolio. They go out of real estate and they go into stock equity, and they go out of this and go into emerging economy bonds and I don't know what. So that's a rather normal process, and somehow that would rearrange. And as I said, there must be limits to it. I don't know where exactly the limit is. I guess about financial assets of about, say, 100, 200 or 250% of GDP that might be tenable and acceptable. But I have doubts whether 200, 400, 300, 400 is still tenable or desirable, and certainly not more than 1,000% it was the case in the United States of late. That's untenable.
This camera stopped, so we can ask a very simple and clear question. So if you talk to German politicians like Herr Schäuble or whoever, I don't know if you ever did, but what would you think, where is the problem? Is it a problem of understanding? So this is a very subjective personal impression. So if I try to talk about these things, normally I get a feedback of people that they simply don't understand it. Simple example, my father is a teacher. He's now retired, so he has been teaching politics and for 40 years, and he could not explain that system of trading
because it's contradicting his whole worldview. You know,
no. This is not a
this is the only reason always for people not
in the case of my
believing.
father, it's not. He simply doesn't know it. And if you go out on the street and ask people, look, what do you have in your pocket? The money, can you explain how it comes into this world? You will, to 99.9% get an answer, no, you can't explain it.
So you need media to publish it. You need to own media.
Yeah, that's one thing. But my question is, if you ask professionals like Mr. Schäuble should know these things of financial. It's so highly responsible what they're doing. They should understand it. And my impression is they don't understand it. So I would really. What is your experience?
Is this directly to what it says?
No, it's from last session. Their patient.
I want to ask, is it must be a global decision of all the countries have to decide about the banks that they are going out of the system, coming to the other system? This is the problem. So one country is actually not making kind of emphasizing of what is happening. Or it's
Well,
possible to start somewhere and then...
It is, yes. It is. I mean, it's a decision that has to be taken on the state level, so a decision that has to be made by the parliament in any case. And it could be any country. In principle, it could be any country, but practically speaking, I think the probability of success is more with the countries with a certain tradition of rule of law, stable economy, stable political conditions, and, well, for example, Switzerland, Norway. Even with this mess of debt crisis, I would say most of European countries and American countries and Japan and South Korea, I would say, and so it could be, and the probability might be that some of the emerging economies, because I have realized that ever more people from countries from emerging economies are becoming interested in that approach.
Yeah, China is starting already. They transfer huge amounts of money to the people.
Yes.
Now,
so
it's amazing.
Yeah.
So they are the leaders of the new world. We think in terms of we were the leaders, and the US, it's gone.
The United Kingdom could do it. The United Kingdom could do it. Why not?
Yeah.
Sweden could do it. I think even single countries within the European monetary union could do it, but that's not very probable, and I think not even desirable. But, so now to come back to your statement or commentary.
It's a question.
Yeah. No, it's a big issue for us. It's an important question, and everything starts in the mind, within the mind, and within representing the world within the mind. And the problem really is the bottleneck. According to my experience, the bottleneck is established paradigms that are today, since we have knowledge society or academic knowledge society, the bottleneck is academic paradigm. And because politicians and other functionaries in associations and so on, the experts they refer to have all been brought up and have been educated to think in that framework of academic paradigm, that the textbook paradigm of economics. And that's, according to my experience, that's the bottleneck.
That particular bottleneck is the neoclassical, almost theological assumption that money is created by the state, that debt doesn't matter, in fact, we write it out of our
Yes, right.
So we are controlled by the wrong guys.
Yes, I mean, you see, politicians in person also are from almost all stripes, political colors, are ever more interested. They have heard about that type of monetary reform. It's not an official interest, but on a personal level, they have started to become ever more interested since about 3 years or so. And that's gaining some momentum. The entire process is gaining some momentum. But, well, you see that story with the glass, whether it's half full or half empty. I mean, it's an awkward business, because that process, a paradigm shift, is not something that happens within 1 year. That happens normally within several generations, at least within 5 up to 10 to 15 years. And excuse me, now it's his turn.
In your what you call sovereign, what was it?
Sovereign money?
Sovereign money, yeah. Where does the whole debt or interest concept line. It's still there.
Well, according to our idea or to our approach, the circulating money base would be free of debt. It would be transferred from the central bank to the government, to the treasury, to be spent into circulation, free of interest, and also with an unspecified maturity, let's say. Just for spending it into circulation, and that money would remain would stay in circulation. That's the model, I guess, within that system. From time to time, under certain conditions, that the central bank would have to credit some money directly to the banks. Why not? That would still be interest-bearing to the central bank. And in the entire economy, when banks are, in the financial economy, when banks are making out loans to customers, that would continue to be on a basis, that would be the market would be regulated by interest, by the level of interest and the amount of interest. That would be interest-bearing.
Because I don't understand how it is, interest is a pure mathematical concept. And the universe of mathematics is completely abstracted, and that's why you have Zenon's paradox with the turtle and the rabbit. In the mathematical universe, the rabbit never reaches the turtle. That's true, but it does in a finite universe with the bodies that have extension. And so this whole interest concept is purely mathematical, and our world is finite. So it is.
No, I agree with what you say, but
So
I wouldn't say that
it's going to clash.
no, the concept.
Any monetary system with debt will clash with a finite world, with finite resources. So in order to have a sustainable world, we have to completely eradicate the...
I agree with that, but I do not agree with saying that the concept of interest is an arithmetic model. It isn't. Interest has been a historic development by experience. No. And modern economists have started to consider that in terms of mathematical models. And then, of course, you can say that the model of compound interest that cannot work in reality, I think everyone agrees. Because, as you say, it's, no, not even that, by the way, that compound interest model. I mean, that's just the first part of a function, which will at some point reach an inflection point where it will take the shape of an S-curve. I mean, that's a different issue, but you are right, I think, in saying that reality cannot bear compound interest unlimited. That's certainly not possible. The important question is, what is interest, or what does interest contain? What is interest composed of? What are the elements or components that go into what we refer to as interest? So there are several components. It's an insurance, an amount of risk insurance, and it's an amount of inflation insurance against inflation. It's a certain component for paying for the service delivered. I mean, people in banks rarely work, and that work needs to be paid for. And there might be also a component of undeserved extra profit, very probably so. But in reality, it's very hard to figure out how much money is for which part of that, for which component, and where starts the extra profit component, which is unlegitimate.
You're avoiding the essence of the question. The value that interest creates is purely fictional. and it keeps increasing, by this mathematical model, it will clash with the finite natural resource.
What you say would be true if the entire increase in the money supply if the entire increase in incomes, I have to say, not the money base, in incomes, would stem from additional credit.
It can be.
But in reality, most of the money, it's deferred income. Income deferred from earned income to investment income. That's the point. And that's why we have that derailing income distribution, that ever more money, ever more income, I have to say precisely, income, not money, income, is going to return on investment, interest on capital, and not going to earned income. And that is the problem.
That could be offset.
Redistribution of wealth on the basis of interest.
Income is for capital, but it's not for people because actually it has nothing to do with still hunger or the dependency on the third world that is so dependent on the first so-called world and the resources. So it has nothing. It's something that it's completely different value, and it's impossible to measure it in what you invest. Important for the common sense to work together. So
yeah.
So it's actually something.
So okay.
I have a question.
Yes.
Question.
Yes. Excuse me, please. I beg your pardon. I would like to accept one or two more commentaries or questions, but I beg your understanding. I start to feel very tired right now, and I would like to suggest to come to an end of our session, if you agree. So then let's have please one or two more.
I would like to know if you, by creating this new system, there are many people thinking about new monetary systems in different forms already. So they're all popping up now. And do you have in mind that the old system was about maintaining control in the overall sense of the old system was maintaining control for the few. So every new system we create has to transform the power from the 1 to the 99. And this can be the only goal, transforming the money into the hands of the people until we don't need money anymore. This will be in approximately 40 years. There's so many things happening right now most people don't know, and of course the old system is still looking for sneaky ways to build up new systems and try to sell the new systems as the new shit. But on the one hand, it's a soft copy of the old, because these people are really smart, and I think we can. I would like to know your opinion about it, more the human opinion, how you want to see the development going and the visions, because now we're entering a period, the so-called Age of Enlightenment, and all the crazy kids coming up now, and they are amazing. And so how we can transfer this power more into the hands of the people? Is this the common idea of your project in the long run, or
please question or comment, not a speech.
I always have a speech. It's my life.
But I don't like speeches.
That's
I
your
try
problem,
to ask a
my
question in
friend.
half an hour.
Yeah.
I would say we would have reached quite a lot already if we could make sure that decisions are taken by the legal bodies the bodies who are thought that their task is to take the decisions, and not informally by that 1% or even less percent of the elites. But you know, that's a problem in any part of society. It's a problem in finance, in the economy. It's a problem in politics, in party politics. It's a problem in the top ranks of the ministries. It's a problem in the military. It's a problem in the education system.
It's the humans.
So yes, that problem exists everywhere. And I would like to remind you that the metaphor of the 99% and the 1%, empirically this refers to income distribution. That 1% of income earners cash in, how much was it, 20-25% of the entire income. So that's the figure. It's not necessarily that exactly that 1% have control over the entire money and financial system. That's a different question.
They do.
But in fact, it's. I think you are right in saying that, as a matter of fact, it's not the people who decide, but it's the elites.
Yes.
But I want to make sure, at least, that the elites who decide can somehow be controlled by some sort of legal process, which is in some way has a
massive democratic
some sort of formal democratic control, and how should I say, elements, we had that issue before, elements of people's democracy or direct democracy have to be built into the existing parliamentary system to enable people to come in, to intervene in the process. But the management of the process itself, the operations, the day-to-day operations, that will very probably always be in the hand of some sort of experts, and those experts have to be kept under control, because if not, they start to become independent informally in a certain way.
My question is coming back to the idea.
Yeah.
If my research is right, if I understood right, then to switch to monetative would mean that the state is getting the seigniorage.
Yeah.
Now, if they are getting the seigniorage, the private banks are not getting it.
Yes.
If I stand right, this is an amount of somewhere 40 to 50 billion per year in Germany.
No.
No? Do you have an idea how much money we're talking, which is not earned by private banks anymore?
Yes. When I the first time published that entire project together with James Robertson on behalf of the New Economics Foundation, we tried to figure out how much money it is. And it's difficult to find out.
Let me put it in another way.
Yeah.
The question is, if we do that tomorrow, are the balance sheets of the banks crashed because they?
No.
No.
No, there are. That's a different issue. These are two different issues. Let me first comment on the first part of it. The seigniorage government would have from issuing sovereign money. That's original seigniorage in the original sense, where the term seigniorage comes from. Seigniorage was the profit the sovereign made, or the crown made, or whoever had the right to coin money, from producing and issuing that money. And so the profit was identical with the purchasing power of the addition to the stock of money. So if the sovereign made or produced in addition to the stock of money, to say of about 1,000 ducats, in Venice or so, then the seigniorage was 1,000 ducats less the cost of production. So that was the original seigniorage. Since modern money is electronic money, it's digital money, the cost of production is very, very, very low. So you can say that modern original seigniorage would almost equal the face value of it. So if the central banks concludes that the economic potential from one year to the next is roughly speaking about 2% or so, or 1.5%, then the addition to the stock of money, augmenting the stock of money by about 1 to 0.5%, that would be the seigniorage, that amount of money. In difference to that, by contrast, what the banks call seigniorage, misleadingly so, that's a margin extra profit, which banks gain from making out a loan, which they have to refinance by 2% cash, 6% by 9%, say. So if bank credits customers a loan, it credits 100% bank money, itself has to refinance just 9% of it, which is 2% cash, 6% central bank reserves, and 1% minimum reserves within the European Monetary Union. Could someone please ask these persons to be less noisy?
Can you please be quiet there? It's okay. Thank you.
So that is the interest, the extra profit that the bank is realizing. And it is difficult to compare, because the seigniorage foregone to the public purse nowadays is a different amount of money from what the banks take in as that marching extra profit. They misleadingly called seigniorage as well. Or the finance economists misleadingly call seigniorage as well. And so, to my knowledge so far, to my interim knowledge, let's say, the original seigniorage would be higher than the marginal extra profits the banks made, because the bigger part of the bank's profit comes from not only and not just from creating money, but much more from using that money for financial investment purposes, and so on. And the difference also is that the interest on money credited by the banks has to be paid continually. It doesn't matter whether the business cycle is up or down or whatever. The debtors have to pay the interest on a continual basis. Whereas in such a system of sovereign money, the creation of new money would follow the business cycle. If there is growth, we need much more money. If there is no growth, we don't need more money. So that's the difference. There might be years, particularly in, say, 1 to 3 decades, when we more and more come closer to what nowadays is called a post-growth economy. Post-growth economy.
What is growth?
Well, in the sense of addition to the GDP. Real GDP, inflationary GDP.
Just another bourgeois reform system. No place in
Yes, right. Okay. So now that's the difference between original seigniorage and extra margin profit by the banks. I have figured out one time, a couple of years ago, an estimate, but that refers just to Germany. And the estimate was that the extra profit the German banking sector has from creating bank money at that 4 years or 5 years ago was at about 19 to 24.5 billion of euros, and the entire banking profit was at about 19 to 100 billion euros in that year. So it's a considerable part of the banking profit, but it's not the biggest part. It's not the lion's share, and banks won't go.
More or less a quarter of the profit. But more or less a quarter of the profit is gone.
Yes, about, yes.
which for me is okay, but nevertheless we have to tell shareholders and people what are the consequences of this action.
Could you work together with the basic income idea? Like, so this idea is becoming bigger and bigger really fast because people understand it, and I think two new systems combined together to satisfy the business financial world in a sense, and to satisfy the people, so to make the transition more soft for everyone.
Yes. I myself, I have been one of the original supporters of the concept of basic income or guaranteed income when it came up again it has a long-standing history of its own, but it came up again, say, in the course of during the 1980s. I'm actually a lifetime member of Biennale, the Basic Income Earth Network. And one of my original inspirations when working out that approach in the 1990s was the idea how to finance basic income. But unfortunately I had to find out that seigniorage from creating new money on a realistic basis would never be enough money to finance basic income or a guaranteed income. It would just be a small part of it.
But it's still thin air.
Yes, it's in the air, but
it's still created out of thin air. Always, even the new system is thin air. So.
Wait a moment. Wait a moment. The money is created out of thin air. Modern money, but income is not created out of thin air. Someone has to work for it. Mm-hmm. So if we spend or credit new additional money into circulation, that is, so to say, an advance on the future, on a promise to deliver in the future. So goods and services have to be produced in the future in order to justify that additional amount of money. So you see.
But the idea, it's when I think it had lots to do with belief system, because people are becoming now more aware of the reality construct itself. What money is, like you said, it's just in your head, and the more people become aware of how the value of money is created inside their heads, and how they can open up to this endless universe and the full prosperity this universe delivers to everyone who's open to it. There are so many new ideas have to fit in this new working system, because you can construct a new system with the old belief system. Like Einstein said, you can create you can solve a problem with the same kind of thinking, creating the problem.
Yes, sure. I agree more or less, but let me quote figures from memory. I tried to find out. Now let's start with the basic income. How much money should it be? The income, 1,000 euros, 1,500, or 2,000 euros per month. What would you say? 1,000. Let's say
1,000.
How much is your rent? How much is your rent for your flat?
Well, that would not be enough. But if you start from, say, what you could finance by a realistic increase in the money base, is just about, depending on the country, just about 35 to 60 euros monthly. And it's not 1,000. And that's the relations.
But this is like, in a sense, I think.
I'm very sorry.
I know where you're thinking.
I myself, I was very disappointed when I found it.
I know, because you found it out, because you use this old way of that. Maybe when you keep in mind that this new system is only there, the only reason for this new system is to transform these all ideas of the 1,000 years we had before.
May I help you?
Please.
Please look on a website called staatsbürgersteuer.de. I'm very sorry, it's only in German. But I looked 4 years to find a tax system which answers your question. Which I'm also a basic income fan, and I always look for how to find it. And what I learned is monetative is okay, but it's only a part. You need a solution for the 1,000 euro. Look on this way.
But you say, what you say that reminds me another thing which might be of interest to everybody here. A way proposed, an alternative way has been proposed how to issue new money in a reformed system of sovereign money. And that alternative would be to pay it out as a citizen's dividend. That money goes back to C.H. Douglas, a monetary reformer in Britain and in Canada, at the same time as the silver Gesells time in German-speaking countries. And he had that idea of national dividend or citizens' dividend. And so an entire amount of, say, 100 or 150 billion euros annually that could be fortnightly or once annually that could be paid out to all citizens. And they would have, it would be a fortune, but I think it would be very popular. And that was really practiced in reality the first time in the 1740s and 50s. And that was later the state of Maryland in the United States, at a colonial time still. And because they had a lack of money, they started to create their own colonial bills. That was sovereign money. But the Crown in London disagreed. And in fact, it was found out it was not that much the Crown, it was the bankers. The London bankers hated the governors in the colonies, that they printed their own money and no longer were dependent on the bank money from London. And so they were lobbying, the London bankers were lobbying the Crown and the Parliament in order to stop the money creation by the governors of the colonies. And that happened in 1750, I don't know why.
Like the greenback, for example.
Now, the greenback was later in the 19th century, but that was the time of colonial bills. And that was the main reason for the War of Independence and the Declaration of Independence. It wasn't the tea tax, but the tea tax was a sideshow. The main reason was the bitterness of that intervention on behalf of the London bankers. Because in the state of Maryland, that newly created state money or sovereign money that was handed out to the taxpayers, it was given to the people. Here you have, go on, do good things, let money circulate. That was wonderful. They had annual growth of 6 to 7% and no inflation.
What happened?
Yes, the bankers intervened. They wanted to stop the system because it created independence.
So we should do the same.
Yes.
Yeah.
That's what we propose.
Okay, on that note, I'd like to thank Professor Huber for coming to talk to us. He must be exhausted. And then if you want to answer some more questions in private. Thank you very much.